The modern-day world presents us with an environment which is overly noisy and congested. The international markets are often no different. However, like in life, if you can take the time to clear your head and focus to understand what traded instruments actually are and what drives them, then you often see a clearer picture. This is often how I approach trading. Hi, my name is James, and I'd like you to join me as I discover the markets. Today's subject is one of the most traded commodities on the Forex market, and that is gold, with the hope that at the end of this video, you have a better understanding of the driving factors behind this yellow metal. Now, there's an old Wall Street saying that says put 10% of your net worth into gold and hope it goes down, as when gold prices rise, it often means that things are going wrong elsewhere. Though this relates more to the physical gold market, today we're talking about the gold spot market. Gold spot is a trading instrument which you can trade practically 24 hours a day on the Forex market. Unlike its physical counterpart, where you have to purchase gold from a licensed distribution organization or a licensed exchange and make arrangements for receiving and storing it and find either a buyer and a seller, with spot you're simply speculating on price movements, where if you get the direction right, you can benefit from both buying and selling it. Now, one of the first things many market analysts will always say about gold is that it is a safe haven. Now, a safe haven is an investment that is expected to retain its value or increase its value during times of market uncertainty. With this in mind, the market often looks towards gold when there's a lacking confidence in currencies and higher risk asset groups such as indices. Due to this, the market often tends to monitor the performance of indices, as in the past, if they have fallen, you can see gold prices rise, and vice versa if these instruments have risen in value. Now, though gold is traded against other major currencies, the key relationship has always been with the USD, which can be dated back to the Bretton Woods Agreement established in 1944. Though this agreement was ended in 1971, you can often see the love and hate relationship between the two. Over the long term, a declining dollar has often meant a rise in gold prices. In the short term, this is not always true, and though there is a special relationship with the USD and gold, gold is a global commodity, and the price of the metal can often reflect the global sentiment. That is why it has often shined for investors during times of both political unrest and conflict. But there is no doubt the USD strength can play a major role in the value of gold. So here are some key economic indicators from the United States you have to keep in mind. US initial jobless claims. Consumer price index, as gold can be used as a hedge against inflation. US GDP. The FOMC announcements. The Fed best rate decision. US non-farm payroll. These events, of course, can be found on the financial calendar. Also, another fundamental issue to bear in mind is though we are talking about gold CFDs, gold is still a physical commodity and prices can be affected by supply and demand. So it's often a good idea of being aware of the amount of supply coming from exporters of gold, such as countries like South Africa and Australia, as well as demand there is for gold from major central banks around the world. So, in final analysis, the key areas you need to be aware of when looking at gold are as follows. Global economic sentiment. Is there a demand for a safe haven? Performance of the stock markets, including indices. Global political issues and conflict. The special relationship with the USD. Is the USD rising in value? Key US economic indicators, and the supply and demand for gold. Join me next time as we look into key factors behind trading the euro dollar. For now, thanks for watching, and you trade safe.